Welcome to Altus Insights podcast series with Ray and Marlon, hosted by me, Avi. This podcast will cover monthly market updates and construction cost impacts across major markets in Canada.
Welcome back to the Altus podcast series with Marlon, Ray, and myself, Ray Wong. Today we have once again, as part two of our U.S. Canadian discussion, Omar Eltorai, the Director of Research at Altus Group, again, with more than a decade of experience in the industry, in the investment management and financing roles. And Omar's focus at Altus is on macro capital market trends affecting the U.S. CRE market. In the first part of the discussion, we went with an overview of the capital markets trends, the overall flow of investment activity in 2022, what we expect in 2023 north and south of the border. And we're going to continue on with our discussion, the part two, covering the industrial and office market. So, Omar, welcome back again. I'm glad you actually came back for the second round.
Happy to be here. Thank you.
In Canada, it's been red hot for the last number of years with record low availability rates across Canada, with 20 to 30% increase in land and rental rates. So, Omar, what do you see in the U.S. market?
Yeah, so industrial remains to be one of the, I would say, hotter segments of the CRE property types in the U.S., whether that's based on pricing, but and just overall demand is still there, not only for transactions, but also for the space itself. You still see rather, low, so single-digit vacancy across many of the major markets, and the net absorption is still very, very strong, even though the property type has seen some, I would say, skepticism enter the market, especially when compared to the 2021. The fundamental, there is a case across most of the major markets that the fundamentals are still intact. And then also I would say from a pricing standpoint, it is one of the areas that is still desirable and it is not, hasn't necessarily fallen off, and there is still transaction activity taking place.
So,
okay. Sorry, go ahead, Marlon.
So this is where I go and do the negative thing. Where does this eventually end? Because like the gold rush at the Klondike, it started fantastic. It looked great until it wasn't. And the way I usually look at this stuff is a lot of it's driven by online shopping. And my buddy Brian, as much as he likes to buy every tech humanly possible from Amazon, at some point there's nothing else left for him to buy. So when does it slow down, or is this like forever now?
Yeah, so this is where I would take it, even though real estate is it is local, it's understanding assets, it's understanding the market that those assets are in. I actually think that to answer your question, I would look at the macro level, because I do think that that's where there are some bigger signals coming through there that are a little bit more concerning. So on the highest level, I would say, looking at and now I'm speaking just about U.S., right? So looking at households' financial position going into, coming out of the pandemic, it's really the strongest financial position that the households have had ever, right? So they had large cash savings, they had low levels of debt obligations. So essentially just, whether it's credit card, mortgage, auto loans, they were able to service that. They had robust investments, right? So looking across their stock portfolio, their bond portfolio, just all marketable securities. And that put them in a very high, the highest kind of like net worth that the American household has been in before. But a lot of that has started to change. We're not at, red flag level, but as the Fed started raising rates earlier in 2022, that hit a lot of the rate sensitive assets, largely home prices, which we're starting, those move a little bit slower, but we're starting to see some softening there, as well as marketable securities. So as the markets became more volatile, markets and 2022's year for stocks really was a sell-off year, and during a lot similarly to how markets will react during times of stress or distress, right? You see cross-asset correlations heightened. So even though the stock market was falling, diversification wasn't really possible, or you didn't get the benefit there. And so a lot of the overall, both fixed income and equity markets happened to lose. That hurt the household position. You're starting to see, even though the American consumer has not slowed down their spending, they've been fine because they were eating through a lot of the savings that they had accumulated during the pandemic. However, we're starting to see that more borrowing is needed to fuel that consumption. And on top of that, what makes this extra painful is that credit card or installment loans, which is how you would effectively fund this if you have no cash savings. And those rates are at all-time highs, right? And so the money that they are borrowing now to buy the thing that they wanted yesterday, today, now it costs them about 5 times as much as it would if they had bought it last year. So that's a really long-winded way of saying the trend, if the American consumer continues to purchase at the same rate that they have been, the way that they will be able to do that is by buying it with much more expensive money, and that will so either something's got to give here.
Okay, so Omar, again, we're pulling it back to real estate. The other thing you just said with respect to perhaps the debt is starting to go up with consumers, and we may see a slowing because of the interest rates, and for industrial. Rents in Canada have increased 20 or 30%, right? So you must be seeing the same thing in the US with pressure points. So there's only so many increases that companies can push on to consumers. And do you see a bit of a risk there in regards to the last sort of increases in rental rates and as well as the cost of some of these, especially these newer buildings with the super flat floors and the high automation with racking, the cost of these buildings, right? Do you see that as a bit of an issue going forward, especially for owners and investors?
Yeah, and I would say one of the big areas that is also a bit concerning. So at the high level, right, knowing that there is demand and the market is tight, I think that is that is quite supportive. But really the way that I see industrial is that this is going to become very, market focused. And I know that I'm sure, listeners may be rolling their eyes because I was always told that, real estate is, especially commercial real estate, it's idiosyncratic, right? Like you need to understand the individual. No two assets are the same. And I get that, right? Okay. So, but I acknowledge that. Now we can move on. I think that the story for industrial, when we're talking at the sector level, is very much going to be market. You're going to see some pretty drastic, differences in performance based on the market.
Okay, Omar, which markets?
I would say one of the tightest is like Inland Empire. Whereas, I think that there is, there's a real, those fundamentals I think can support, and not only within that market, but then the role that the Inland Empire serves for the overall kind of supply distribution across the U.S.
Okay, so what else? What other markets do you think that is basically a safe bet on industrial that we shouldn't have a challenge with higher rental rates? I'm thinking New Jersey, because we've heard stories with New Jersey with respect to some of the vacant land is actually being a little bit more in demand, whereby they're keeping the goods in trailers and they're actually renting the land out to store goods.
So that's actually I love that you brought this up, and this is going to be, maybe not going off script here, but I think that they have recently learned a little bit more about it's called industrial outdoor storage, so IOS, which I actually think is a pretty cool way of, or it's an interesting evolution or innovation of kind of a business plan of monetizing monetizing a real asset in a way that honestly I had not thought of or really before, but it ultimately falls under that industrial use case. But I think that it's I happen to like that, because one of the things that I'm looking at, especially across sectors now, is if we do have sticky inflation plus high cost of financing and or volatile markets, that means that really understanding the stability of cash flows is huge. And if your top line growth, right, and we touched on this on the prior call, is that if your top line growth is maybe variable, but that expense management component is in my view like really critical, because you can't have this volatile top line but have only steadily climbing expenses, because that will ultimately erode kind of your overall profitability. And something like industrial, I think, has had the kind of attractiveness because it's been relatively lower kind of expenses.
Yeah, in the last 2 years, we've also made that shift from just in time to just in case. So those are further increasing that demand. I think we're going to put industrial into a little bit more detail with a future podcast. But before we jump over to the office side, where do you see cap rates moving?
Specifically for office?
Industrial. And go into the office.
Yeah, well, I would refer everybody to the last episode when I went on a long tangent there. But I think the answer is up, which is, and that's the TLDR Perfect. On this. Yeah,
Perfect. We'll leave it at that.
All rates are going up. Yeah.
So let's move over to the office sector. So this whole thing of going back to the office has been a big discussion for the last 2.5 years. First, it was temporary. Now it looks longer term. Now is a lot of discussion with the evolution of office, on how we actually utilize the space. So the space itself, how we utilize it, and how the space adapts to the needs of the workers and companies. What are you seeing in the U.S. with respect to the office market and this battle with trying to bring employees back into the office?
Yeah, so I think, and I'll answer the second one first, is that's bringing employees back to the office, I think, is going to remain a real challenge. You have a number of firms that are taking strong stances and saying, we're expecting you back in at 3 days, but you get 2 remote. Some come in saying that you effectively, they want their employees back the entire time. But so long as we have kind of stubbornly low participation in the labor market, plus even though you've heard about like layoffs, the labor market is still in the U.S. is still super tight, and employee costs, so the cost of labor is still climbing higher and is just expensive. The remote option for a lot of employers will remain a benefit of sorts. It's a non-monetary benefit that they can put out there to attract employees. So I do think that it's going to be tricky to force everybody back to the office. And then on that, for office, if looking at the most recent Castle data, if really occupancy is right around kind of 50%.
Sorry, Omar, the Castle data is the security pass cards, or what is that?
Yeah, exactly. Yes. Sorry. Thanks for pointing that out. Yeah, it's they do the security passes on a lot of buildings, and they put out these weekly reports, and they break it out because apparently lawyers are very different. But lawyers are always in the office apparently. So, but I guess so the occupancy right now, if you squint your eyes over these reports, right, it's roughly in that 40-50% range across the big cities, which pre-pandemic, you had, really in that 70 to 80%. And so that's a big drop right there. Before the pandemic, remote work existed, but it just wasn't adopted. Pandemic happens, it fast forwards behavioral changes that on their own before would have taken years and years to kind of like play out. But the adoption was very fast. That has shifted where the office market now looks dramatically oversupplied.
Now we know that the return back to the office is relatively low, right?
Yes.
What do you think going forward with demand for space? Do we still need office? And then this gets into Marlon's comments that from a performance standpoint or ROI standpoint, do these buildings sort of make sense down the road with respect to supply and demand?
Yeah, so I do think we still need offices, but I also think that we're dramatically oversupplied. Now, how that, how the office, what do we do with the oversupply?
You know what? I think it is also based on a region, right? I think a place like Nashville has a little bit more, you have a younger population, and same thing with our Calgary office. But people, I'm now talking about the Calgary market, which has, it still has about 30% office vacancy rate, but it's improving. But then I'm always reminded, it's still 30% office vacancy rate, but there's a lot of young people there, and it's becoming dynamic. So same thing with Nashville. I think there's a demand for office there just because of the lifestyle, the number of young people, demographical shifts. But I think something like the larger markets, where Chicago's and New York's, which not just have problems bringing people back into the office, but they also have a 2-hour commuting problem that Marlon and I have in Toronto. Right?
Yeah. Cities, that's the problem. Really bad transit systems that don't function. Yeah.
So when you look at that from that perspective, Omar, where do you? It's a difficult question to ask, and we're not asking for what the total answer is. But is there thinking of possible direction on some of the positives and negatives on the office front? And then we'll get into your cap rate question.
Yeah, no, absolutely. I do think that there are some positives, especially if you fall. So in the last couple of years, right, you have seen big migration. There have been a number of places that have seen huge influxes and outflows of residents, right? And so a lot of those markets, I'm thinking of like the Austins, I'm thinking of Miamis that have seen huge growth. Those I think are certainly whether it's undersupplied or they will be able to essentially have enough demand for office space. Others, I am a very proud New Yorker, right? I do think that there is it's going to be tough to just justify, whether it's prices, values, or just, cash flows remaining the same when, half the use, or half the demand has been really wiped out. So, but I know that that's also, especially like in New York, right? That's on our mayor's, radar. In, I think it was January, he announced, plan to support conversions of empty office to other uses, including like residential. But Marlon, I mean, you could probably chime in on this of like the practicality of those conversions.
No, it's very low. But I mean, the other way to look at it, though, doesn't this move into a state that's natural anyway, in that the older buildings that aren't fit for use anymore, that culling them actually makes natural sense? So in essence, we get rid of the garbage And the tier A stuff that meets high ESG standards, well, in the states that haven't banned the word ESG yet, but places where ESG is recognized, those tier A buildings, that they'll then maintain the value because we get rid of the stuff below them. So that oversupply vanishes, and it may be conversion, it might be replacing it. I think part of the challenge we're going to see on replace now is obviously with ESG, the carbon. Okay, if I demolish a building, I've done all that waste. Well, that's good, but if the building's useless, the building's useless. There's no way of solving that problem. And the office conversion, like 1 in 10 maybe, if you're lucky, you've got any suitability, and even then it's difficult and huge risk. But to me, I think it's a natural sense that we just got to make sure. One of the problems we have in Toronto is if you tear down an office building, you have to replace that work use on the same site, even if the site is the most ridiculously useless site in the history of mankind. They still force you to do it just so they can tick a box. I think if we had planning change and policy that promoted this natural evolution of office, the office will just evolve. The tier A buildings will be in demand. They'll still have those higher rents they can claim. It's just the garbage vanishes from the bottom of the food chain on that asset type.
So, Mark, cap rates, direction.
I'm going to predict this one. He's going to say up.
Wait.
Up.
Okay.
See, I knew that was coming.
Okay. I think we're going to explore a little bit more with some of the similarities and differences with the U.S. and Canadian markets going forward. So I think we're going to have Omar back for at least a few more sessions to expand on this discussion. But thank you very much again for round 2, Omar, and thank you for actually coming back. Not very many people do. So this is I thought this was a really good, interesting episode on office and industrial trends. So again, thank you very much for everyone attending and listening to this podcast. So we'll see you for the next one.
Cheers, Omar. Cheers, Ray.
Cheers.
Yeah.
Bye.